All right, guys, we are almost at the end here. And last week we talked about unemployment. If you're watching this video and you have not taken the quiz on unemployment, I would suggest that you go ahead and stop and do that because we're starting a new topic. You need to take the quiz that will cover the terms about unemployment, which you've already had a quiz on. This quiz is both terms and then the types of unemployment from last week's lecture. So if you are up to speed and you've taken the unemployment quiz, we're going to get into the design of the tax system. So we're talking about taxation, and we're going to talk about a couple of things this week, just in two lectures. One here that we're starting right now on the hows of taxation. How are the taxes collected, in what format, what type of taxes, and where are they going to, and where is it being spent? And then we'll get into the evaluation of the tax system. One thing that ManQ says is that most people agree that a tax system for any form of government should be both efficient and equitable. And now how you define those terms, efficient and equitable, is a different matter. Okay, to be efficient, we could just say that the government could just reach into your bank account at any time, at any place when they need money. That's efficient. So certainly we probably wouldn't agree that ultra efficiency is what we're looking for. What do we mean when we say a tax system should be both efficient and equitable? When we say equitable, do we mean that everyone should pay the same number of dollars in taxes, the same percentage of taxes? Do we mean that everyone should pay what is a fair tax burden? And then how do we define that? So we're going to put the efficiency and the equitability questions in the second lecture. And this lecture, we're going to just handle the design of the tax system as far as how the taxes are collected, how much is collected, and in what form. And then we'll end with where it's going as far as the spending of tax money. So here we go, the design of the tax system. All right. Well, first of all, when we're talking about taxes, that can be kind of a term. We say, well, what do we exactly mean when we say taxes? And so I picked this picture to kind of because I like the idea of all these various waterfalls that you see. Okay. You've got all kinds of different points along these falls where water is separated and running down the mountain in any one stream, okay? But if you were to go to the very top of this mountain, you would find one water source, right? Where all these different falls is coming from. And then imagine if you went down to the bottom of the falls. You can imagine that all these various falls and the streams that you see in the picture of many, many different places and types, okay, are going into one basin at the bottom. And so we have this idea that the taxes can come in many different formats, and that they are varied in their collection, how they're collected, how much is collected, but they're really all coming from the same source. Sorry, guys, they're coming from the same source, okay? And so what kind of taxes are we talking about? Well, we're talking about income taxes. This is a tax on your actual income, what is deducted from your paycheck. But you're going to notice that payroll taxes are not the same. So when we say income taxes, this is taxes deducted from your income. And it doesn't just mean from your wages earned. We'll get to that in a second. Also, corporate taxes. What Frito-Lay has to pay the government for existing. What Ford has to pay, right? What Amazon has to pay. Corporate taxes that are taken off of corporate profits that are made. And then payroll taxes. Now, payroll taxes are those paid usually by the employer, okay? And so when you are an employee of a place, that employer will take money out of your check for you. In almost all cases, it's set up this way. If you're self-employed, it's different. But if you're with an employer, they will take your income tax out, and they will also take out your payroll taxes. And the payroll taxes have to do with your Social Security contribution, which is called your FICA contribution, and then also your contribution to Medicare, and if you live in a state that collects it, unemployment insurance as well. Okay, and so you have these automatic taxes that are taken out of your check each week. When your employer takes these taxes out, they are taking half of the amount out of your check and they pay the other half. Okay, and so I believe that the Social Security, the FICA contribution is 14.2%. So 7.1 comes out of your check, your FICA contribution, and the other 7.1% comes from your employer. So in other words, when we hire people at Seven Rivers, or any employer does this, we have to think about their salary, okay? We have to think about their benefits, their insurance that we pay for, that we help to pay for. If they're getting any kind of retirement benefit or things like that, if they've worked for the school for a significant amount of time. But we also have to think about that part of their pay, part of what it will cost the school to employ them, is called their payroll tax, or our contribution toward their Social Security and Medicare amounts. And so that means that employers pay half and employees pay half. And together, I believe that number is 14.2% for your FICA contributions. Okay? And that makes you able to able to withdraw, to draw on Social Security later in life. Now, does it really make it able? In other words, like this money is really there and it's being saved up for you to withdraw later? No, it's being spent, and Democrat or Republican will admit that the Social Security plan is not going to work and that there has to be some kind of solution for it. But it's a very difficult solution that some people don't want to swallow politically or don't want to take on. And so it hasn't been handled yet. And Mankiw addresses this in the book. I'll tell you where when we get there. Okay, so income taxes, corporate taxes, payroll taxes, sales taxes. This is probably one of the ones that everyone is most familiar with because everyone in here pays sales tax. So when you buy an item in the store, if it's a taxable item, like a non-grocery item, a toy, a Matchbox car, silly bands when you were little, if those were even around when you guys were little, right? Then they were taxed. And sales tax. And then property tax. If you own property, if you're a homeowner, you're going to pay property tax. If you own rental property, you're going to pay property tax. If you own acreage, you're going to pay a property tax. And the property tax appraiser will assess the value of your property, and they will give you an amount that you need to pay in property tax on that property. So those are just different types of taxes that the government collects at various levels of government. All right. So we want to tackle two things, right? I said this at the top of the video. How much does the government collect from the people that they're taxing and how are they spending it? And then how can we determine if this taxation is efficient and equitable? And I said here that we're going on the assumption that we're rational people, okay? So rational people want taxation to be efficient, not inefficient. And rational people want taxation to be equitable. Now, we all might define that term in different ways, but most people would say they want the tax system to be fair. People are not going to raise their hand and say, I want a really unfair tax system, okay? So they want a system that's efficient and that's fair, and we're going to tackle these things in our 2 lectures, and we're already on our way. Okay, so we were saying that when a country is small or new, it collects a relatively low amount of revenue in most cases. This was certainly true for the United States. Your text starts out by talking about how Ben Franklin believed that he only was taxed about 5% of all of his income. And that included property taxes, any excise taxes or sales taxes that he would have paid. Of course, in Ben Franklin's time, there was no income tax, and the income tax wouldn't come about for quite a while. And so not only are there fewer taxes, but there's just a lot less collected earlier on in our government's history than later on. So let's take a look at this graph. If you look here, all right, first of all, a couple of things to note. First of all, it starts out way back in 1902, And in 1902, this is even after the U.S. Civil War, when a much higher amount of taxes was collected than ever before, you can see that there was still a very small amount of total revenue as a percent of GDP. So in other words, think about if you took the GDP of the United States, okay? And you said, all right, of the total GDP, what percentage of that gross domestic product of everything produced in the United States, that dollar value, remember the dollar value, guys, of everything produced in the United States, what percentage of that is being taken by the government in taxes? And so we can see that number way back then was just in 1902, a little bit over 5% of total GDP. But today, that number is far higher, right? Today, look at toward the end of the graph, you can see that that number has reached close to 30% at times in the country's history. And we might even say that some time in the more recent, it has reached about 33% of GDP. And so that means that there had to be a significant growth of what the government was collecting, and we would assume what they're spending, right? Because they're not just collecting and keeping it somewhere. In fact, the government runs huge deficits despite what they collect. So they're spending, not only are they taking a lot more, but they're spending a heck of a lot more. All right, and when did this start? Well, you can see it creep up, but you can see a very big increase by 1941. And so there's two things that I want you to note that take this government revenue as a percentage of GDP, to take what they're taxing the people on and what they're spending, and it takes it to a much higher level. First thing is, of course, FDR's New Deal. FDR's New Deal was truly groundbreaking. Whether you like it or hate it, it was groundbreaking in the terms of what it believed that the federal government had the right to do. Remember all those alphabet soup programs of the AAA, the Works Progress Administration, the Tennessee Valley Authority, the laws that helped NERA, all of those alphabet soup programs that you learned about in your U.S. history class, right? Those were groundbreaking as far as the federal government taking on a taxation power and a spending power that it never had before. Even FDR talked about this in his inaugural addresses as wartime emergency powers that he would take if Congress did not give him the right to what he thought needed to happen economically. And he basically said the economic circumstances, this is before the war, by the way, are wartime footing. We're fighting a depression. I can take emergency powers. Okay? So FDR spending, that was a breakthrough. And then on top of it, the spending in World War II. So between the 30s and the 40s, right, we have a whole new role for the federal government and the state governments. Now, I made this note down here at the bottom to point out that if you'll notice, the blue, right, is 2/3. See that there? The blue is 2/3 of what is going on in that graph. And that tells us that 2/3 of all that money collected is going to, hold on, I'm going to bring myself back up here because I forwarded that slide again. 2/3 of all the money being collected is going to the feds, and then 1/3 of the money collected is going to the states. Okay? And so that tells us a little bit about how much the government is spending. The richer a nation gets, all right, the more money seems to be taken from its citizens by the government, because that government is going to spend a lot of money. Also, ideologically, what a nation believes about what it should pay for on behalf of its citizens has an impact. So let's look at this chart that tells us the amount, the taxes as a share of gross domestic product in various countries, okay? So if you were to look at France, okay, what that is telling you, the very top number here, okay? What this is telling you is that France, out of their total GDP, 46.2% of the French GDP is then taxed by the government away from the people and then given back to the people, we would assume, or other people, in some kind of services, transfer payments, okay? So whether France is taking this money and then spending it on giving a great education or a poor education or a great vacation or a poor vacation or healthcare, good or bad, or foreign aid, or spending it on war, spending it on weapons, spending it on interest, spending it on corruption, whatever a government is spending it on, okay, good or bad. The French government is taking 46.2% of all the French GDP. They're taking that in taxes and then turning it around and turning it into some kind of a benefit for someone, okay? Now, the United States, by comparison, we're down here, 27.1%. This is in 2017 numbers, I believe. And so before the end of the tax year in 2017, this was taken. So the United States comes a little further back in the pack if you compare it to countries that have a little bit more of a liberal focus or even a soft socialist focus, a democratic socialist focus, like the Scandinavian countries here and like some of the Western European nations. And so you will notice that they're out ahead, all right? The United Kingdom and Japan are a little bit down closer to what the U.S. is doing as far as the total. We're spending about a quarter, right? A little over a quarter of our GDP is being taken by the government for taxation and then turned back around and spent on the people's behalf in some way, shape, or form. So we fall, as Mankiw calls it, mid-pack. But he included in his numbers that fall below us, Canada, Russia, Pakistan, Indonesia, Mexico, and India. If you want to look at his graph, it's on page 243 in your text. Moving on. This is not really 100% in our purview here, but I found this graph when I was looking around for graphs, and I loved it. This is a comparison of states, and it shows you the median household income and taxes. And what I loved about it is that you can do a quick glance and get the amount of money going toward your federal payroll, right? See, the dark blue is your federal payroll. The yellow is the amount of your income going to property tax in a state. The gold is your state income tax, That's a tax that the states charge you on your income in addition to the federal income tax, which is red. Okay, so the federal income tax is the red number. Federal payroll employee is the pink. Gas tax, okay, is the dark red. And sales tax is the light blue. So if you come down here, for instance, to Florida, see if I can find Florida here. Okay, found it. If you come down here to Florida, all right, you can see that we're not going to have a gold bar, and that's because Florida does not have a state income tax. All right, now look at the light yellow, the property tax. Now, compared to a lot of the people, like if you compared Florida's property tax, for instance, to Tennessee's, right, you would say, well, theirs looks to be a little bit smaller, or West Virginia's looks a lot smaller. But you have to see if they, for instance, with West Virginia, have a state income tax. One of the reasons that we have a little bit higher property taxes in the state of Florida is because we do not have a state income tax, and the property taxes go to the state. Now, who's paying property taxes in Florida is an interesting question that I don't think we're going to have time to get into, but if you want to talk to your parents about homestead exemptions and how they work and whether or not your home has a homestead exemption and whether or not your parents might own another piece of property, like for a business or a second home that they can't get a homestead exemption on, and how that affects the total tax money that Florida is allowed to take in. I don't want to take more time to do that, but maybe we can talk about that at our Thomas Sowell dinner sometime if we get to have it over the summer. So you can see the income, but you can also see the breakdown of how this tax money is, how much of the income is taken out. You can look at which states have a higher amount, and because this also has to do with what people make totally, right? So the federal income tax is the same. The amounts are the same. But because people in Florida make a little bit less than, for instance, people in the state of Washington, the total federal income tax that is paid from the state of Florida is certainly going to be lesser, okay? Okay, moving on. All right, so let's talk a little bit about income tax. When we say income tax, we might think of tax on wages, right? The amount that we pay on our wages. So we work a certain amount of hours, and the government takes the income tax out of our paychecks, out of our hourly wage, and that's income tax. But income tax is on any form of income, okay, that isn't protected in some kind of tax shelter. All right. So interest on savings. If a person is not working and they have lots of money in a savings account and that savings account is bearing interest and it's not a specially protected type of account that is made to take out the taxes either later or earlier, and this gets into some finance questions that we don't need to get into, then that interest on savings is taxed. Also, dividends from corporations. If you have your money in stocks in a corporation and that stock is, you can't get at it, okay? You own the stock, it's in your portfolio, it represents value, but you can't really get at that value. And so corporations sometimes pay a yearly or quarterly dividend. They pay you a little bit of money for owning the stock and sticking with them, right? Well, if you make profits off the dividends from your stocks, you are paying taxes on that. If you make capital gains, if you are invested, let's say, in a mutual fund, okay, or you sell your stock, let's say that you sell that stock, okay, and you make money off of the stock. Let's say that you make $50,000 this year over selling some shares of Amazon that you've had since you were a really young kid. Okay, well, congratulations, number one. And number two, you're paying a capital gains tax on that. And my friends, that is on money that you've already paid in income tax. Let's say that you bought the stocks with money out of your paycheck that had already had the income tax deducted. Well, yes, you're paying again at your capital gains point. When you cash in that stock and you make a capital gain, you've got to pay on it. Inheritance. Now, sometimes the heavy inheritance taxes are put on temporary reprieve by Congress. Sometimes you'll hear this called the death tax, but there are certainly times in American history when inheritances have been taxed. There's something called a gift tax. If you are given a gift over a certain amount, there's a gift tax that can be applicable. Winnings. Hey, let's say that you go on Jeopardy and you win $120,000. You know what? That is also taxable. So your lottery winnings, your game show winnings. I had a friend once that won a vehicle from one of those car lot giveaways, and guess what? They owed the sales tax on that car, even though they won it. They still had to pay the sales tax on their win, and it was pretty pricey. And so your tax liability is on all kinds of income. All right. And so income tax actually is quite a big gainer for the United States federal government. This shows you the receipts of the federal government, okay, back in 2010, just for kicks. All right. And it says from individual income taxes, okay, if you look at the total the government takes in is 100%, right? 36.7% of their money comes from taxing people's incomes. The slide we just went past, right? Taxing people's incomes, dividends, capital gains, all that, right? Next, social insurance taxes, Social Security and Medicare, 41.1% of what the government pays, gets in receipts is coming out of, it's still coming out of your paycheck, okay, but it's not income, it's taken out before your income tax. Then corporate income taxes, what corporations pay to the United States. And you'll see that that number is a little bit lower, only 13%. Now, keep in mind that everyone who works for the corporation, the CEO down to the janitor who sweeps the floors, they all pay income tax on the money that the corporation pays them to the federal government. Okay, but as far as a corporate tax, what Frito-Lay and Ford owe to the U.S. federal government, that is their corporate income tax. And then there's other sources of taxes as well, right? But these things all equal 100%. Now, I forgot to mention this before. What your total tax liability as a family is, that's called your liability. Okay, adding up all that your family could owe in taxes. Okay. Now, our next big question is, what is the marginal tax rate? Okay, so let's get some things very clear here, okay? This is very important. Guys, I know we're at the end of the year, and I know some of your other classes are done and wrapping up, and you got AP exams that you took this week, but I want you to listen to me, okay? We have to understand what kind of tax system we have in the United States. There are different types of tax systems that governments can institute, okay? There can be lump sum tax systems where you just pay a lump sum. The government says, everybody owes us $1,000. It's a lump sum. Everybody owes it. All right. There are also proportional tax systems, regressive tax systems, and progressive tax systems. All right. And we want to look at these and understand them. Now, I just want to make sure that you get this. All right. A proportional tax system is when people pay a proportion of their total income. So a lump sum, everybody pays $1,000. If I make $10,000, all right, and Madison Welter makes $100,000, and Hunter makes $1 million, all right, and we pay a proportional tax, we each pay 10%. What did I say I made? 10,000? Okay, then I'm going to pay $1,000 at a 10% tax rate. Madison is going to pay $10,000 and Hunter's going to pay $100,000. That's a proportional tax system. That's what some people mean when they say equitability. In other words, well, since Hunter's making $1 million, he can afford to pay more in taxes, and so we'll take $100,000 of his money, 10%. And since Madison is making $100,000, we can take 1,000 from her, and I will only pay with my 10,000 from her, and I will only pay 1,000 from my $10,000 income. Okay. Now that's a proportional tax. That is not the type of taxation we have in the United States. We have a progressive income tax, and it's illustrated right here on this information that is sourced from the IRS. You can see it. I took it straight off this Tax Foundation page to the 2020 tax brackets and rates. So look over to the side, okay? And basically this is telling you that if you as an individual, okay, make below $40,125 a year, okay, then you're going to pay on that 22%. If you make between 9,875 and 4124, you're going to pay 12% in income tax. Now look, when you get into the higher numbers, if you make anything $500 to $18,400 as an individual and over, the federal government, not all your tax burden, listen to me, not property taxes, not sales taxes, not inheritance taxes, not winnings taxes. Your income tax rate is 37%. But what do we mean by the marginal tax rate? Okay, by marginal tax rate, what we mean is there is an amount for every additional dollar that you make over a certain amount. So in other words, on the first $10,000, everyone is being taxed 12%. But for every dollar that you make over that, okay, for every dollar that you make over that amount, that second part of your income begins to be taxed at that higher rate. Okay, and that is a progressive income tax, because the more you make for every dollar more, right? That's what marginal means. The tax rate applied to each additional dollar of income over your bracket. So, for instance, if you make $70,000, okay, the first $70,000 will be taxed at the 22% rate. Okay. Oh no, I'm sorry. If you make $70,000, the first $40,000, 125 will be taxed at 22%, and then it will start going up. Okay, after that. So in other words, you're going to get taxed in the bracket, and then the overage, you'll be taxed at that higher rate, and that is called a marginal tax rate. And this is why some people do not want to, as you might have heard it called, move into the next tax bracket. They don't want their income to go above into the next tax bracket because it's not worth it to them if it's going to be taxed at a super high rate. Okay, it's not worth it to them to be maybe making that next dollar amount because it's going to be taxed at a higher rate than their other income is taxed. Okay, so the Mankiw gives an example. You can look at it on 244. He says, for example, a person with an income of $1 million pays only 10% on the first $7,150, or in here it's actually $9,875 because the numbers in Mankiw are a little outdated, but they pay in the additional brackets as they go. And trust me, they're going to pay plenty, okay, as they go forward. There's a tax organization, a tax watchdog group, and one of the things that they do is they give a date every year that they call Tax Freedom Day. And they do this, they're an interest group that's interested in lowering people's tax rates, but they do this to kind of point out the fact of just how much of your income, when you're looking at this rate, you say, whoa, $37,000 of income. I mean, 37% of my income is being taken if I make over 518. Right. And so you say, well, but that's a lot to make. So they'd still have a lot left over. Okay. But what this tax group does is they try to do it in time. So think about this. They'll make a day where your tax liability is done being paid for. So they might say something like, they might come out on, April 24th and say, guess what? After today, you get to keep all your money. You gave all your money to the government since January 1st to now, whether we're talking about income tax, sales tax, all the taxes that you're going to pay, payroll tax. And starting today, April 24th or May 3rd or whatever that day is, Tax Freedom Day, now you get to keep everything you make from here on out. Now, that's not literal. We don't mean that literally the government takes all its money up front, okay? But what we mean is that that's a long time to work to pay the government. And so go look it up. Go look up Tax Freedom Day and find out when it was in 2020. All right. And you can see how long the average American had to work before they were done paying their tax burden and started to get to actually pocket that money themselves. All right. So we have marginal tax rates that tell us what we're going to get charged. Right. Going back, we talked about income taxes, what makes them up. Your social insurance, your corporate income tax, and your other make up the other part for 100% of gross receipts. But we do want to note that most of the money that the government takes in is coming from taxes out of paychecks, income taxes. Okay, so now we want to ask, where does all this money go? Right? Where does all this money go? Since the government's taking in a lot, what do they exactly spend it on? And so I want you to, before we turn the slides, and we're almost done, guys, so be patient here, okay? Before we turn the slide, I want you to ask yourself, what do you think the government's biggest categories of spending are? What do you think they spend the most money on? What is their single biggest budget item in the U.S. government, right? What do they spend their money on? Here we go. Number one, transfer payments. First of all, it's interesting to note that the number one thing that the government pays for isn't a product. In other words, it's not a good or a service. The number one thing that government pays for out of the Treasury is to transfer payments from one citizen or group of citizens to another citizen or group of citizens. And this is done through transfer payments. This can be any payment where the federal government collects it from a taxpayer and then turns around and gives it to another person. Now, Social Security goes to anyone who's drawing Social Security once they reach the age of official retirement age, usually of 65. They can apply to start drawing their Social Security. I think they can apply a little bit earlier, okay? And so they'll start drawing a Social Security check. Now, I understand, okay, if you're getting all hot in the collar out there, that people pay into Social Security. I mean, we just talked about that, guys, right? We just talked about the Social Security, the FICA contribution out of everyone's paycheck. But what I want you to understand is the money that's currently being paid out in Social Security is future money. It's not money that's been held in the bank from all of your grandparents and great-grandparents and my parents and great-grandparents. That money is already spent, okay? This we are spending the future. We are spending the current generation's payroll deductions on today's retirees, and it is sinking fast because we have a lot more retirees than we do young people. And by the way, we just learned last week there's a whole bunch of people not in the labor force. Remember, not working, not making incomes to speak of. And so this is a very big deal. And the transfer payments that the government is paying are very, very costly. And they represent a huge amount of total federal spending. In fact, the category equals 22% of total federal spending. That's a very, very big number. All right. So what do you think the next biggest category for government spending is? I'll give you a hint. On this one, they actually buy actual goods sometimes. And they also buy labor. And it is the Defense Department, national defense. So the government might buy military aircraft. They might buy tanks or armored vehicles. They buy labor. All right. They buy employees. Think about how many people are employed by the Department of Defense, all of our U.S. military. And my friends, our retirees in the military. Their pensions. All right. They're being paid by the military budget, national defense. That's a huge category for the United States to spend money on, and it is the second largest category. Now, some of this depends on when. Are we fighting a war? Or are we not fighting a war? Are we at a time of peace? Are we in a military buildup or a military slowdown? So Mankiw mentions from 2001 to 2004, in the Iraq War, it made up 17 to 20% of spending. Okay, what do you think the third category is? If we've got transfer payments like Social Security, national defense, what about welfare, right? Welfare payments, social assistance payments. This could be in the form of TANF, our old friend, temporary assistance for needy families. It can be in the form of food stamps, EBT cards, like you see over here on the left, special nutritional assistance programs, housing help. Okay, so anything that we would put in the category of welfare. Okay, now this is paid for both by the federal government and by state governments in partnership. Okay, so there's federal welfare programs and then there are state welfare programs, both coming out of the tax revenue. Next, Medicare. Medicare is, of course, and kids get this confused all the time. Okay, let's get something straight. Medicare pays, it is medical insurance, okay? It is retirees' medical insurance. So you start getting Medicare after you're 65, and everyone in the country, okay, who's 65 and older gets Medicare. Medicaid is a means-tested health insurance. Means-tested means they test your means, your ability to pay. Okay, so a means-tested program is a program like welfare, a program like Medicaid. They want to see your income, how much you make, what your circumstances are, what your means are, and then they'll decide if you qualify. Medicare and Social Security are not means-tested. Okay, that is, if you're over 65, you can draw based on what you contributed for Social Security, and you can have your medical care, at least a large percent of it, paid for by Medicare. Okay, so Medicaid is the one that's means tested. It would be under the welfare slide. Medicare is for all Americans over 65. Okay, that's Medicare. Here's another category: the interest on debt. Remember how I said that governments spend more than they take in? Well, what do then? They borrow it. They borrow it in treasury bills. They borrow it in IOUs, right? They borrow it in selling government debt. But they have to pay interest on this, okay, to the people who are holding that debt. And guys, this interest is a lot, and it is growing by leaps and bounds. The amount that the government has, that the Fed has pumped into this economy, okay, over the last few weeks, whether you agree with that that they should be doing it or whether you don't is absolutely staggering. Okay, and there is going to be interest to pay on this. Now, this particular thing projects it out to 2028. What is the 10 years worth of interest payment that we're paying on our debt? $6.9 trillion. How do you get out of government debt? Well, there's only 3 ways to do it. One is to declare bankruptcy, old-fashioned style, right? Like the Al-Sudis did, like Venezuela does when they get into trouble, and that collapses your economy, okay? Number 2, you can stop spending money you don't have and then pay this down with your wealth and your GDP and your taxes that you collect. Number 3 is you can raise taxes. And neither of those 2 options are real politically popular. And the United States just keeps accruing more and more interest on debt. Some economists think that this is a horrible, horrible situation that is going to cause the American economy to collapse at some point. Some economists don't think that that is as big of a deal as others. And this is actually covered in a section in your book in chapter 36. It's called 5 Economic Debates. And if you have time to just flip back there and look at it, just a quick 2 pages, and it talks about why some economists think the debt is a super big deal and some economists are not as worried about debt. And so you can take a look at that. All right, but that gives you the biggest categories of spending for the United States. It tells us what the United States is collecting, from whom and in what form, how they're spending it, and we can move on next time to talk about, is the tax system efficient and is it equitable? All right, have a great day.